Hello, everyone, and welcome to another edition of the Richard Haynes Real Estate Show. I'm your host, Richard Haynes of Manhattan Pacific Realty, soon transitioning to Haynes Real Estate under our new branding. We are excited to have you here on the show. It is late June. We are almost, or actually yesterday was the summer solstice, but we are officially in summertime and almost at the July 4th holiday, one of my favorite holidays. Kick up the feet, enjoy the sun, and have a good time with family. You guys, this week's episode, solo podcast. Next episode will be a new guest that I think you guys will enjoy very much, but this is going to be one of those episodes where I share my thoughts on the market, some anecdotal evidence, and then obviously some numbers that you come here for once a month. The three topics we're going to be covering today. Topic number one, what we are seeing in this market contextually with our clients as buyers and sellers. Topic number two, I'm going to get into inventory numbers, you guys. You hear about too few homes for sale, an inventory squeeze. I'm going to dig into those numbers so you actually understand how big of a squeeze it is historically and what we're looking at today. And then finally, topic number three, predictions on what might hold for the rest of the year. And I'm also going to look at my 2023 predictions that we had at the beginning of January and see how those are panning out. And let me tell you, spoiler alert, I've actually been pretty good at nailing them, and I think they will continue. So long way to go with the year, but I'm feeling myself a little bit with the predictions. But let's get right into it, you guys. End of June. We are essentially halfway through the year, you guys, and what an interesting start to 2023. I mean, really, it's been quite an unprecedented 4 years in real estate, and particularly in the South Bay. In 2019, we saw softening prices. In 2020, we had the up and down wildness of the beginning of COVID, then a surge in 2021, and then kind of a tapping or a topping out in 2023 thanks to rising interest rates. And then here in 2023, kind of people not knowing what's going to happen and the headwinds that high interest rates have caused, but that have been offset by low inventory. And what we are seeing today with our buyers is still, you guys, a challenging environment. I will tell you, I think 2020, 2021, 22, and now 23, it has just been hard to be a buyer because it's been a wild ride. You have low interest rates, but then this incredible rush and prices surging. And now that you have interest rates higher and you think prices could soften up a little bit, they don't, and you're left with strong prices and even fewer options amid higher payments. What we are seeing in terms of at least buying clients that are getting deals done today, you guys, all cash. People who are making deals happen, people who are buying homes. They have previously owned homes. They've done very well in business. They've sold a business. They've inherited money, or they're just trading properties that they've owned, and they are buying with all cash. That is a big theme. And so that is what's keeping Manhattan Beach very strong. That's what's keeping the prime areas of South Redondo strong, Hermosa Beach, and then the coveted areas of the Palos Verdes Peninsula. You are seeing cash transactions or buyers with very large down payments to offset these higher mortgage rates. And because of the supply squeeze, we are seeing strong to growing prices in Manhattan Beach, in Hermosa Beach, in Redondo, and Palos Verdes. Now, if you look at the year-over-year quarterly numbers that I talked about last solo podcast, the numbers are actually down. But when you think about so few deals getting done, there are deals getting made in a strong manner because buyers have so few options. So yes, prices are down when you look at the pure numbers, but there are significantly fewer deals getting done. The highest of the high end is now kind of slowed, but the meat and potatoes of every market, or at least the strong markets, they are getting deals done at medium price. If you price at what a home is worth or slightly lower, you are getting multiple offers. In North Redondo, a 3-bedroom or a 4-bath starter townhome that's somewhat affordable, $1 million to $1.5 million, multiple offers. If you're getting that starter home in Belmonte, multiple offers. If you are getting that new construction rare tree section property that has the 5 bedrooms that everyone wants and is move-in ready, multiple offers. So the market is still strong with all cash buyers. Premier areas are still hanging in there. And sellers, if they don't make a mistake on price, their properties go. Are they getting the record-breaking premiums in every market? No, but they're selling efficiently. The prime markets are continuing to go higher. And only if you were a major beneficiary of the pandemic, the faraway markets I talk about, or small homes with giant backyards, because that's what everyone wanted, the faraway markets are struggling a little bit. The small home is selling for more of what a small home is worth rather than getting a giant premium for a big backyard, because that's all anyone hung out in 2020 and 2021. The markets are hanging in there, you guys. So challenging environment, especially for first-time home buyers. Cash offers are reigning supreme. And sellers, you're lucky because inventory is so low, which I am going to get to. And as long as you don't make a mistake on your price, your property's selling. People who reach for the record price or come out too hot are paying dearly for it. And that's maybe where you see some of the weakness in certain pockets of the market. But overall, we are strong. And we are going to look to the quarterly numbers next month, which if they're down again, maybe in my head, I'm making up that buyers trying to buy are having trouble. But I really do think our markets are strong because, quite frankly, there just isn't enough inventory. So that's enough of those anecdotal thoughts in an opening. Let's get to those inventory numbers, topic number 2, and actually get deep into the numbers, because all we hear about is there's no homes for sale, inventory is low, there's a supply-demand issue. Let me quantify this for you in numbers. I'm going to start with Los Angeles County because that is a bigger data set beyond the South Bay, the beach cities and the Palos Verdes Peninsula. And those big numbers really help kind of level out any craziness. And I'm just going to take the month of May. LA County, big area. Month of May is a massive month. And we're going to look at it compared to some past years and last year and this year and try and give you some context of what effects we are seeing from low inventory. So let's talk about this. 2019, the final year before COVID, so the last quote-unquote normal year, Los Angeles County had 20,425 homes on the market on the MLS. So a little over 20,000 homes were on the market in 2019. You guys, when we saw the surge in 2021, that dropped from 20,000 to just under 14,000. So you saw a 30% drop in inventory at the height of the market in 2021. In 2022, as interest rates were going up, it fell, but fell about 1,000 homes. So or 2,000 homes, from 14,000 homes to 12,000 homes on the MLS. Okay, well, interest rates are rising. Now they're really high in 2023. You have to see some softness and maybe sellers not selling as quickly and inventory growing. No, that is not the case. In 2023, we have now dropped below 10,000 homes for sale in the market. In fact, in May, just last month, in all of LA County, homes for sale were 9,200 homes. So let's backtrack. 2019, last normal market, 20,000 homes on the MLS. Today, or at least last month, 9,200 homes on the market. You guys, that's more than a 50% drop in homes for sale compared to the last normal year before COVID. And when you look at 2021, almost 14,000 homes on the market, 2022, 12,000 homes on the market, so slowly going down, and now we're at 9,200. This, to me, is at least an incredible stat, you guys. We have seen plunging inventory during the run-up, and it hasn't gotten better even as we peaked, and now that we are at 20-year high in interest rates, we're even lower. So I hope that gives you an idea of the big inventory we're seeing throughout Los Angeles County and in other areas that are strong in California. Yes, there are other places nationally that are slowing down. You hear about Austin is slowing down. You're going to hear about pandemic markets that other people fled to out of the expensive states, California, Chicago, New York, and those markets are now slowing down. But and some of those markets are seeing a doubling of inventory if you want to get outside of the South Bay and LA County. But here we have an amazing inventory squeeze, and we are down in LA County over 50% compared to 4 years ago, and down significantly from 2021 and 2022. Okay? I'm going to fly through some of the cities because I don't want your eyes to glaze over. But Manhattan Beach, I'm just going to run through 2019 compared to 2023. And I want you to know essentially inventory in 2023 across all cities, not all, but very close to all of them. 2023 is lower than 2021 and 2022. But let's show the drop-offs from 2019. Manhattan Beach, May 2019, 155 homes on the market. Today, or at least last month, 2023, 69 homes. Massive drop, you guys. Hermosa Beach, in 2019, May, 67 homes on the market. May of 2023, 41. Redondo Beach, 2019, homes on the market, 162 in May. This May, 80, 50% drop. Palos Verdes Estates, May 19, 98 homes on the market. This May of 2023, 44. Rolling Hills Estates, 39 and 19, 16 today. Rancho Palos Verdes, 155 homes in 2019 in the month of May, now just 54, essentially a third of what it was 4 years ago. You guys, these numbers are incredible. We are seeing 50% lower, 66% lower. And I'm telling you, across the board in 2021, there was more inventory than we're seeing today. And in 2022, many cases, even lower inventory, and now even lower. So there is a major supply squeeze in the South Bay, you guys. Yes, the quarterly numbers are falling, but buyers simply have too few options, and the ones that can buck these higher interest rates are essentially forced to buy at the same prices, even though their payments have gone up significantly. Before I move on to the final topic, I'm also going to give you some greater Los Angeles County statistics just to give you some context of what the real estate industry is feeling, because you hear realtors talk about like, oh, it's slowing down, our business isn't as good, and that's not because the market isn't as good. There's just fewer transactions and less volume. So agents are making less money, title companies, escrow, moving companies, inspectors. Real estate punches above its weight in the economy, and the Fed is actually doing their job by slowing this down. Prices are actually holding in there, at least here, hanging in there, but they're slowing down all the employment around real estate, and people are making significant less money, which will hopefully lower inflation and maybe lower rates down the road. But to give you an idea of LA County volume, so I'm talking about when you add up all the prices of homes that sold and you come up with volume, in May of 2021, during the craziness of the pandemic, there was $15.3 billion worth of home volume in May of 2021. In May of 2022, this is when rates were really starting to go, there was $14.5 billion in volume. So we saw a $700 million drop. Not a lot, even though interest rates were going up higher, but in today's May 2023, volume is below $10 billion. So 2 years ago, we had $15.3 billion in volume, and now we're below $10 billion. So that's a 33% drop, which means 33% less commission, escrow fees, title fees, movers, et cetera, et cetera. So that volume is going to hit insurance companies. It's going to hit moving companies. It's going to hit real estate agents, escrow companies, everything around it, and why you kind of see some negativity in the market, even though sellers aren't getting hit as hard as people might have thought. And then last but not least, let's talk about actual transactions in LA County, May of 21, about 6,500 in home sales. In the next May in 2022, 5,500. So 1,000 transactions fewer from 21 to 22 in May. And then this May, last month, 4,300 transactions. So you go from 6,500 transactions in May of 2021 in LA County to 4,300 transactions. That's a big drop, you guys, in terms of the velocity of transactions. All right, I'm going to leave it at that. Hopefully that context on LA County and our local cities was helpful to help really give you an idea of this supply squeeze that everyone keeps talking about. It's a big deal. It's serious, and that is what's offsetting these high interest rates. If we ever saw supply tick up, get back to 2019, or even get 50% back, closer to 2019, we'd see buyers with a lot more leverage. That's just not happening right now. And the final topic, thoughts on the market. Recapping some of my predictions at the beginning of the year, halfway through. Let me give you my thoughts first. Thoughts, you guys. I am feeling like our markets are going to stay very strong, even if interest rates are elevated for longer. And the number one reason is the supply strain. But number two is demographic trends. And you've heard me talk about this before. The millennial generation is coming of age later in life, in their mid-30s, in their late 30s. And that's kind of the first part of the millennial generation. They're finally starting to have families. They're taking off in their career. That is a bigger generation than the baby boomers. And the baby boomers created a housing surge in the 80s and the 90s and offset higher interest rates as well, because there were so many boomers and so much family formation during that time. They bucked 14% interest rates. There was a lot more building and more supply, but now there's fewer building, fewer supply, and you have millennials coming in droves into this housing market. So while it is expensive, while there are too few homes, and yes, how many people can afford this? There are just too many millennials coming down the pike who are going to be buying homes that are going to support this market. Now, if we go from 6% rates to 8 or 9% rates, that's going to be hard to overcome. But if current homeowners want to keep their homes and have golden handcuffs because they have 3% rates, the large millennial demographic starting families, starting to finally make some big money and have some savings, they're going to keep our South Bay markets in demand, and I think it's going to be hard to see prices fall if all things stay equal. So that's my thoughts on the markets currently. Let's quickly get to some of my predictions from my predictions blog and predictions podcast in January. I'm going to run through it quickly. Number one, select South Bay submarkets decline double digits. You guys, the prime areas of Palos Verdes are not seeing double-digit declines. Most of them are seeing strength or flat, or yes, they did dip, but many of them are strong among the supply squeeze. But I am seeing the faraway markets, the Mira Catalinas, the PV Drive East, et cetera, Los Verdes, their softness there. I am seeing kind of this late spring, early summer comeback that could offset it, but I still feel pretty good that certain submarkets in PV can drop double digits. Prediction 2, low supply plagues market all year. Everyone thought that supply would come back amid higher interest rates. I didn't think so. I thought most people had made their moves, and I thought a 3% mortgage rate, potentially at interest only, was too juicy for people to let go, and that is playing out in a big way. You just heard the supply numbers. That number 2 is going to hit in a very big way, where a lot of people thought supply would come in 2023, and I bet against that. Number 3, another hit. Mortgage rates remain stubbornly, I can't stay stubbornly, very stubborn, but very stubbornly high. Okay, that's not that funny. I can't say the word, but interest rates have remained incredibly high. Jay Powell just came out and said they're not going to hike rates this time, but they foresee more rate hikes this year, and they're going to be higher for longer. So there you go. A lot of people thought it would come, buy a house now in the first half of the year and you can refi at the end of the year. Not happening, and I've advised clients, hey, you got to be able to hold your high interest rate for a couple of years before you have a chance to refinance, and that's happening. Prediction number 4, split market, some rise while others decline. That is, I think, happening in Palos Verdes. I thought that could happen in other areas of the South Bay. I'm not seeing it as much. This could be a miss, but there are certainly going to be areas that don't benefit as well or as much, but they may not decline like other areas going up. We could see flat markets in the places not in high demand, and then, of course, the prime markets are continuing to be strong. Number 5, second to last one, time to buy income or ADU properties. I still believe that. I have clients on the hunt, but man, oh man, supply is tough, and these landlords have great cash flow if they bought any time before COVID and they've all refinanced. So why give your property up at a ridiculous price when you can just hold it for cash flow? So we need more time to tell on that one, and we're trying to get those right deals. It's been tough. Last but not least, my long-term bet. I always do one long-term bet. Mortgages and artificial intelligence. And I talked about how the transaction process would get a lot better with that artificial intelligence, and it's going to first start with mortgages. We don't need people to underwrite paperwork of FICO scores and income and assets and DTI. AI can do that in probably 5 seconds, where a human being might need a week to go look at everyone's stuff. And you know what? I feel great about this one. Everyone's gonna be like, oh, Richard, everyone's talking about artificial intelligence. You have to realize that I made this call when NVIDIA, the chip maker who is all the rage behind AI, was at essentially a low, $147 a share. And now today, just 6 months later from when I made the predictions, it's at a $430 price per share. So almost not a double, almost a triple in NVIDIA's share price. So artificial intelligence was not being talked about in a big way December, January when I made this. Yes, some people were talking about GPT. We were using it, but it hadn't hit the mainstream. And now NVIDIA's surging, AI's all the rage, and I still believe as a long-term bet, mortgages and underwriting are going to get disrupted, as well as other parts of our real estate world. But it's going to start in mortgages, and it's going to make real estate more liquid, and the more liquid assets become, typically the more valuable they get. So there you guys have it. To wrap, I shared what we're seeing, the challenges we're seeing for buyers, that our cash buyers are really the ones winning in this market. I gave you inventory numbers to show historically how deep this supply squeeze is. And then number 3, my thoughts on demographic trends. I really think millennials are going to be a buoy for the South Bay market. And that, hey, 4 out of 6 of my predictions are hitting hard, and really the other 2 could hit as well. It doesn't always happen where I get my predictions right. Sometimes I get less than 50% right. This year looks like I'm going to do better than 50%, if not go 100%, batting 1,000. So you guys, thank you for joining me on this podcast. I hope you enjoyed it. We will see you in July with a new guest and also a solo podcast on second quarter numbers. Have a great 4th of July. Wishing you a happy summer, and we'll see you next time on the Richard Haynes Real Estate Show. Take care.